Hello, everybody. Welcome to the volatility analysis using a value at risk. So today we're going to talk about this particular topic, return and volatility analysis using MATLAB. Well, so this is basically we're going to use the MATLAB to do some analysis. So in MATLAB, they actually provide a lot of toolbox. So all these toolbox can be used to uh, basically they will provide a lot of functions for you to analyze the financial data. So among all these toolbox, so we have most probably the financial time series analysis, and some of if you're talking about portfolio, also you need a set of investment in different areas. Then sum up uh, a multi assets investment. So you can also use a technical analysis to do the prediction, and also another method is called Monte Carlo simulation, okay, to predict the prices or the returns value. Okay. Other than that, you can also use the MATLAB to do the risk analysis. So in short, the time series or the financial time series consists of uh, three of them: price, return, and volatility. So basically, the returns can be obtained from the price. This one, you can actually get it from here. And the volatility also, you can get it from the price. But most probably, you can actually use the proxies of the returns to get the volatility. So the major models we're going to use is the ARMA and GACH. So this is a combination of two models now. One in the returns. So the return. The other uh, models, which is GACH model, is for volatility. So the returns, the forecasting also consists of two of them, returns and volatility. So the market risk basically will use both the estimated or the forecasted value afterwards. Okay. So in terms of returns, you can use the continuous compounded returns. In this case, we can use the natural log or percentage returns, okay, by multiply 100% times the changes of, or you can just write the price, current price minus the previous price. So let's say this is today, this is yesterday, okay? Or in short, in a natural log form, you can just write as PT over the PT minus 1. So this is a continuous compounded returns in the definition using the price PT. So the volatility, on the other hand, you can use volatility, let's say the proxies, okay? So the most commonly used are absolute returns, or you can use the return square, okay? The holding square. So these are the two very commonly used proxies for volatility. So there will be, so we're actually capturing the magnitude, sorry, the magnitude, like, without the positive and negative. So the bigger the value, the bigger the volatility, like, in this case. So in the very famous procedure or SOP to do financial data analysis in financial time series is the Box-Shankin methodology. So in this part, we divide it into three components or three phases. So first is the identify the possible models. After that, we go into the estimation. This consists of the modeling. So in order to check whether your model is free from the serial correlation or arch effect, then you just do a diagnose after that. So if you pass through all the tests, then you can go into the next phase. Else, you need to uh, do some adjustment to your models. So until it actually fulfill or pass all the diagnostic checking. So in the final phase, which are forecasting and the risk determination. So this will be the standard procedure for box checking. So financial data, of course, you're talking about Forex, normally Forex. Then you have commodity price. This is the crude oil, isn't it? So when the war in Iran and in Ukraine, Russia-Ukraine war, then you will see the crude oil actually fluctuating in a more intensive, more uh, uh, the market become more volatile. Okay, so this one is stock market. So of course you can have might be have derivative like futures for all these commodities or precious metals, gold, silver, and so on. Okay. So all of this data set or the financial data set can be categorized into three types of patterns and so forth. So the trend, seasonality, and the serial correlation, autocorrelation. So the first two is quite easy to deal with, trend and seasonality. So you have standard methods to deal with that. So the financial data set we're going to involve in this analysis is more to the serial correlation, right? Also called autocorrelation in the financial data. So by looking at the data itself, we can actually get some information from it. Okay. For example, if you have a random process, okay, let's say this is a random process, most probably you can't see any pattern on this. Let's say this is a white noise random process. So when you say random means you can't predict it, okay, random. But somehow if you see something not random like this one, although the fluctuation is also similar to the first one, but somehow you might able to see some interesting serial correlation in the thing. So in this case, you can see that when the fluctuation is getting more intense, it following by the intensity actually increase. But when the intensity getting smaller, you will follow. So in this case, this is not random anymore. Okay, so this is not random. So it actually provide something, you can say that the large shocks is tend to following by the larger shock. And then the small shock will tend to follow. Tend to means not in the series, you won't see every single, actually there is now, right? Actually there is. Some are very obvious, some are not very obvious like this one. Okay? So you can see a so-called cluster movement. So in this case, it is not only not random, you can say it is not independent. Okay. So this one is most probably independent. Okay. Independent. This one is not independent. Okay? Not independent. So if you check some of the uh, data set, you will actually easily to see this clustering of this volatility. Okay, this is some of the information you can gather from a time series. It's in any of these financial data, forex, stock market, derivatives, or commodities market. Another interesting part is by looking at the price movement and the returns, we can actually find a relationship between these two series. So you can see that this is a Hang Seng index from Hong Kong. So you can see that when the price have a tendency to go up, then after that, then the price will have a tendency to go down. So what you can see in this particular region, the intensity of the swing of these prices or the returns, in this case, this is returns, is less intense compared to when the price go down, isn't it? So as a relatively comparison between the price go up and down, you can see the intensity of the swing is much higher when the price go down compared to the price going up. Okay. So when you say price going downward, this is so-called the bad news. Okay, bad news. So this one is the market actually have inflow of information which is good. Okay, for example, uh, let's say is if you're talking about one company is going to expand their investment, most probably that can consider as a good news. Okay, then those who believe it is good for the market, then the stock price most probably of that particular company might go up. Okay, but let's say if the products have some defects, then the corruption in the management side. So most probably, if this news announced to the market, most probably people will start um, selling the stock of that particular market or that particular company. Okay. So here we use the terms good news and bad news. Okay. So the bad news tends to increase the future market volatility more than the good news at the same magnitude. So in other words, the bad news have a stronger impact on the volatility. Okay, when the price go down, there's a higher chance to become a higher volatility. Okay, so when you have a higher volatility means what? The risk is getting higher as well. Okay, so in finance, this is called the leverage effect. Of course, this leverage is not the leverage you used to do in investment now, okay? But this leverage actually indicate bad news have a stronger impact on the volatility as compared to good news at the same magnitude. Okay, so these are some of the information you can gather from by just looking at the raw data, okay, in terms of price or returns, okay, price or returns. Okay, so in the coming session, we'll look at how to use the MATLAB to do the analysis. Okay, till then, we just have a short break, then we come back afterwards.